All right. Well, UBS predicts tariff tensions will not derail the market, gives an optimistic forecast for earnings season. Let's bring in Evan Brown, head of multi-asset strategy at UBS Asset Management. He joins us here on set. Evan, great to have you with us. Thanks for coming.
Thanks, Melissa. Great to be here.
So signal-to-noise ratio is very low, which means what?
Well, we're getting plenty of noise. We got almost Liberation Day by tweet, all these letters sent out last week, and a lot of big numbers thrown around. But I think what's important is when you crunch the numbers, when you look at them relative to how much we import from all these countries, as well as the exemptions that we have now for Canada and Mexico, it's not actually that much. We've had an effective tariff rate that's gained year to date by about 10%, a little bit more. Even if the president, we don't expect him to put all of this on, we expect some deals to be made, but even if the president puts all of these on, it's just an increase of 2% in the effective tariff rate. So it's not that big of an increase in taxes, and then offsetting that, we just had tax cuts. So overall, we think, the market can continue to digest this tariff noise.
How do you get to an effective tariff rate of about 2% when prior to this tariff brouhaha, it was in the single digits? I think it was like 3% or something like that globally. And then if you just think about, let's say Europe is 30%, let's just say it's half. I mean, how do you get to 2?
Yeah, so we've already gotten the 10% baseline on everything.
Okay, yeah.
We do have reciprocal tariff rates that are getting up towards Liberation Day levels, but you have a lot of exemptions on Canada and Mexico. You have what's likely to be deals with Europe, we think, with the president speaking enthusiastically about the progress made so far. And so there's deals to be made around the sectors versus the actual numbers that are being thrown out on reciprocal.
But on a relative basis, we're heading into an environment where this is more restrictive on the economy at a time when, if anything, we've come into this at all-time lows on unemployment. So I understand that the news is better than we expected, and I understand that we've talked about on this desk that policy statements seem to be there's a lot of tailwinds coming in terms of other pieces of ammunition. How much do you think the market is offsides on the fundamentals?
So I think the market actually understands that the tariffs that have been put in to date are only really going to hit the economy over the course of the second half. I think that's, we are going, whether it's tomorrow's inflation print or just over the next few months, we are going to see inflation rise. We are going to be seeing corporate profits take some of a hit. Someone has to pay these tariffs, right? But the market knows that. It's aware of that. And the market's kind of just ready to look through it because it sees the tax cuts. It sees, an expectation for rate cuts coming, and that's supporting the economy next year. And so I think when you put all of that together, that's setting up for a decent 2026, and markets like to discount forward.
So, Evan, if I go a little deeper on your tax cuts and mitigation on it. So tax cuts are permanent, and the tariffs are maybe temporary, but a one-time effect depending on how they're rolled out. Corporate tax cuts, corporate tax rate went from 35 down to 21%, permanent. Trump has already floated, if you produce here, we can move you down to 15%. So when we worry about corporations passing on tariffs, should we focus more on the fact that they're paying 14% less than they were?
So first of all, one of the things that you're getting with the corporate tax cuts, even though you didn't actually get a move in the number, you got it to 21% last time in 2017. It stayed at 21%. But you're getting these CapEx expensing provisions. You're getting bonus depreciation, R&D expensing. And so all of that is going to support the, bringing the effective tax rate for these corporates down, even while they're dealing with the headwind of the tariffs.
There's a structural move in the dollar going on that doesn't seem to have any correlation with the equity market. But at what point does it, if any?
Yeah, so the dollar dynamics have been really fascinating this year, to your point. I mean, we saw the dollar go down when stocks were going down. We saw the dollar go down when stocks were going up. I think what that reflects is global investors who have become probably over-allocated to U.S. assets are realizing it. They don't want to sell the underlying U.S. assets themselves. They don't want to sell the S&P. They don't want to sell treasuries, still deep liquid markets. But they are saying, okay, some of these correlations are changing. The dollar's not quite acting like the safe haven it has in the past. And so maybe what I need to be doing is hedging that dollar exposure, selling dollars forward. And I think that's why the dollar's continuing to decline. That, in the meantime, is helping U.S. corporations because, when they convert that weaker dollar, their foreign revenues look better.
Evan, let me ask you about this rally. How much of it is predicated on the hope or expectation of the Fed cutting, and how much?
I don't think that the Fed cutting makes that much of a difference, because I think the more the Fed is cutting, it's based on them viewing the economy being weaker and weaker. In the end, I'd much rather see an economy that is holding up okay, right, and the Fed has to do less, than the other way around, where the Fed is easing aggressively because the labor market is breaking. So as long as, the Fed cutting once or twice would be helpful, but I don't think it's absolutely necessary. I think you have enough tailwinds for earnings coming in the next year. The AI CapEx cycle continues and the like. That's going to be able to propel the market forward despite, what's going on with the Fed.
You like what has been working. So Mag 7, tech, AI trade, financials. Is there a shift, though, within these sectors to mid and small cap, recognizing a rotation that seems to be underway here, a search for lower valued companies relative to the S&P 500?
Yeah, so structurally, you're always waiting for these small caps to just explode higher, right? Because they're very undervalued relative to the large caps, and we know how they tend to move once they get going. The thing is that everything needs to kind of fall into place for small caps to really move. You need inflation lower. You need the Fed to be cutting. You need tariffs to not be too much of an issue. And we know a lot of the small companies.
So they don't have any of that, basically. Right
yeah.
Now.
So they don't have that, and that's why we're not ready to get all in on small caps. It's useful to have some exposure to small caps in the portfolio, especially for those moments when they do get going. But that's really the ultimate Goldilocks scenario, and we are still in an environment where we have elevated inflation, growth slowing down. It's not ideal right now.